whether a portfolio invested in an index of shares will deliver better returns than one in which a professional manager selects the shares, active versus passive investing. And again, in the current market environment, we put the issue under the spotlight today. Just what kind of an investor do you need to be in the current market environment to survive? To do that, Mike Estment of NFB joins me now at the desk. Thanks so much, Mike, for joining us this afternoon. Well, of course, we can't really make broad sweeping comments about the kind of investor one needs to be to survive, because it will actually depend on your individual investor profile, but we can certainly weigh the pros and cons of the various approaches. So let's look at passive investing here, passive management first, and weigh the merits that come along with it.
I guess that the first and most important point is that it is unemotional investing. A benchmark is established, a target is set, and the accuracy with which that passive investment instrument tracks what it's supposed to track is how they are rated. So it takes away the kind of subjective calls that a person buying and selling their own shares, or even a portfolio manager looking for either value or aggressive growth or whatever range of outcomes you might look for is looking for. So the passive investment typically is less expensive at first glance. It is unemotional because it's set targets and its tracking error is measured. If it tracks very accurately, it's rewarded in its perception in the market.
So if we look at how trackers actually measure up against managed funds, I mean, obviously debate is rife where we have some saying that trackers regularly outperform managed funds, others saying that passively managed funds are unable to produce better returns than the indices themselves in a falling market. So to a large extent, this would depend on the cycle within which the market is in right now.
That's true, and I think the South African market, you have a very strong bias towards resources and some very large cap stocks dominating our market. In that market, when the tide turns negative, a passive investment has got nowhere to hide. Their job is to stay as tightly linked to that tidal move as they can. That's what they're rewarded by, and they use all sorts of very clever mathematical processes and trading strategies to track as accurately as possible with the lower obvious fees. The active manager participates and charges more for it. He's trying to find what we call alpha, which is outperformance of the tide on the upside and outperformance of the tide on the downside by not getting as hammered. He probably has a harbor in which he can hide from the storm to some degree. Yeah,
long term though, because that's ultimately what we should be looking at. Long term, which makes more sense? Who's outperforming who right now?
Well, the truth of that is that the top 5 or 6 active managers have way outperformed the index over periods, and I'm only interested in periods of 5, 10 and 20 years. The top active guys have way outperformed the index. However, you also get some other managers who would argue they're in that space, have not done that well, and that's where the uninformed public need to become very much more aware. A recent trend is that the active guys have also started participating in the super profits that they generate, the super alpha that they create. Fair in my estimation, but how they measure that has become something of great interest and attention at NFB.
Okay, so let's take a look at, having said all of that, which tracker funds specifically are becoming more popular right now?
Well, in South Africa, you've got the Satrix, which is the sort of the mother of all funds. It's the original one, and there is a proliferation of traded funds that have been built up around that. So the theme is, do you want passive core investment, and then around that build some active bets? That's also one of the outcomes that's very reasonable.
With that, we've seen this proliferation of structured products as well, which is also a type of passive investment but works very differently to a tracker fund. So let's get into that and what that's offering investors at the moment.
I'm going to try and keep my hands steady, because my hands would normally go into the air right now describing the various components. But really, what a structured product is it allows one to buy an investment with a market exposure, but with a safe landing. So you might buy what is technically called a zero coupon bond. It will give you an outcome in 5 years or so's time, 3 years, sometimes 5 years, most often. it will give you an outcome. What's important there is who promises to pay.
Exactly, because you talk about a safe landing,
credit,
but it's that credit risk that comes
Absolutely.
along with it, and whether balance sheets are big enough to actually support that.
Absolutely. They must deliver on the guarantee. That guarantee might be your cash back. It might be your cash plus a level of 4 or 5% per annum, which we think is quite attractive right now. And on top of that, you then get participation through the use of optionality in the All Z40 or some form of equity index.
You say there's a proliferation of these products coming to the market. I mean, how keen are investors at the moment, or is it just a matter of them not being as aware as they need to be?
Well, the funny thing there is that typically you have lots of guarantees being delivered after the market's taken a big hit. And in other words, the horse is bolted. Now we should sort of look at the stable door. In this instance, I think this is an ongoing theme which makes a lot of sense. It's good for individuals. It's good for institutional clients. The individuals have to be aware of the cost of doing that business. So do their advisors really understand what they're selling? Do they understand the lock-in, the liquidity constraints or otherwise? Those questions probably need consideration, because it is something which at institutional level has been around for a whole long time. It's moved much more with much more popularity and quite a lot of zeal into the retail market, and the costing of those can be quite expensive. So that's the question I would ask.